Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
I think embracing the volatility is one of your points, and I think that's a good thing to do. I mean, there's opportunity in the volatility, and you're seeing it today. I mean, if you can be protected to an extent and not have all your chips on the table, and we don't know if this is the bottom or not, and it very well might not be. But just to have the flexibility and to take advantage of that, whether you're a long-term investor or you're providing liquidity, like Gary said, in a pool, and maybe you've been able to hedge some of that delta or impermanent loss that's there, and you're clipping fees. There's a lot of opportunity in this space because of the volatility and because of some of the uniqueness of this liquidity providing opportunities that are essentially a different or a newer form, I guess, of yield.
Hi, everyone. Welcome back. We got one of our What the pods today. Crypto made new down 50% lows sometime early this morning. Rallied most of the way back, but went to grab two of the best crypto guys and market maker guys I know, Ben Upward of Synchronicity and Gary Basin of GaryBasin.com. Of what else? So we're going to talk what happened today, what the overall landscape's looking like. So let's just start. Ben, we'll start with you. Give a brief little background.
Sure. Hey, everybody. I founded Synchronicity in 2015 as an alternative shop. We felt like we were pretty late getting into the space. We got into the digital asset space in 2017 and launched a private fund, and been running that ever since, and that's our main focus. And obviously there's been quite a bit to look at on the screens today, but looking forward to the discussion and hearing what everybody else has to say as well.
Hi, I'm Gary. I've been tracking crypto space since about similar time, like 2016. I helped start a project called Reserve, and I'm not full-time in the crypto space currently, but I track it pretty actively. I do some VC investing and trading on my own, both on centralized exchanges and DeFi.
Your outfit for the pod is all the crypto credentials you need. The tank there.
In Miami too.
And so you're down in Miami, but went to school at Michigan. Ben's over in Michigan. We got any Michigan connections there?
Very possible. I grew up in Farmington, so it was like 20 minutes from Ann Arbor. Yeah.
Okay, I grew up in Birmingham, so yeah,
nice.
Pretty close.
Yeah.
Just a couple of Midwestern boys here talking crypto. So let's keep going with you, Gary. Like, what was the most surprising thing you saw today? What stuck out to you?
Actually, I think most surprising is I didn't see any major protocol failures like in DeFi. I think a lot of people would have expected some cracks to show and a down 30% plus ETH day, but everything pretty much worked. There was no major failures. There's liquidations obviously, but no, I didn't see any stablecoin depegs. I mean, Tether traded like a penny off or something. So that was most surprising. I mean, all the centralized exchanges going down, not really surprising.
Yeah, so I saw it, right, like Coinbase was down, couldn't trade for a little while, and you're saying multiple of them were down?
I think almost all of them other than FTX.
And what causes that? It's just it's just like internet volume and they don't have enough servers or something?
Yeah, I mean, I think basically all of them, FTX maybe I'm not as confident in, are built on like on technology that's kind of a generation behind traditional financial exchanges. So they're not really good at handling load. They're just not really that scalable. So yeah, like too many people trying to access it, too many orders going through the system, and just take it down.
Right. Ben, how about you? What was the coolest thing or most frightening thing you saw today?
I mean, there was a lot going on. Gary's right. It wasn't too surprising. We've seen this in the past in terms of the centralized exchanges having trouble with the loads, and we didn't pay too much attention to the DEX space and the decentralized space today. We were probably a little bit more focused on the future side and trying to use that to hedge some of the positions we had on. So I guess CME held up fine. Obviously, it's a different animal. Cash settled. The futures there. I think one of the things that we've been looking at that we do traffic in those CME options and the Bitcoin futures options, and it's a great tool to have. But I think if we had a wish list, one of the things that we'd really want would be for more liquidity in those options. I guess rightfully so for part of the day when drops were really happening in the morning, very fast and very wide. A lot of the market makers, I think there's only a handful on the option side where it basically kind of disappeared. And so there's ways to work around that for us, but it would be a whole lot easier for us and nicer if we could get a bigger cadre of market makers in the CME options and the big CME options for Bitcoin. I mean, there's reasons why that doesn't happen. I think part of it is the margin requirements versus the other places that they can quote and provide liquidity, like Deribit, for example. So I think to the extent that CME is able to eventually drop their margins a little bit and have the FCMs follow suit, that would be really helpful to us and helpful to them to try to steal try to get some of the market share away from the Deribits of the world, where for us as a US NFA based entity, it's hard for us to access those foreign markets, which definitely would be a lot nicer for us to be able to access that liquidity in times like that. So that's some of the things that didn't surprise us. But I think one of the things that we really hope that during the next whether this is over or not, I don't know, but during the next period of stress, it would be nice to have some more market making capability in those options.
What's the size that you're seeing it both in the futures and the options over there at CME? There's enough size unless you've got a really, really big amount of AUM in the actual futures, the Bitcoin futures. We just started to look at the minis today a little bit, just out of curiosity to see. The micros?
Sorry, the micros, right. And I only looked at the book once or twice. My partner was looking at it most of the day, but I think what you saw there was sort of like half of the big contracts. I think it was like 25 micros aside is sort of what we were seeing the market maker quote there. But generally in the futures and the bigger Bitcoin futures, there's generally enough liquidity there. It's just on the option side, depending on the time of day. And, when we saw guys go in and out, or if it was the same market maker, maybe just putting up two aside and like 800 wide. So, that makes it a little bit tough. First of all, when he's not, when there's no one quoting, and then second of all, obviously when,
and then Gary, what were you seeing on like the non-futures, right? Non-centralized exchange. How wide was it? What was the volume like?
I wasn't actively watching. Well, so most of it is not limit order books, right? It's AMMs. So the volume was obviously very high.
Yeah.
That was actually funny. Like one of the it's like, even though the blacks block rate is very slow, it's like very reliable. So if the web servers are up, you can go pull up a quote and see the most recent trades in a way that you can on these centralized exchanges. But in terms of, I think the interesting thing was they even the perps held up, like the on-chain perps, and the ETH Lido, like the ETH staking protocol, also like stayed pegged and liquid as well. So I think it was probably one of like record number of liquidations, but everything stayed functional and you could trade the whole way through.
And talk me through, like, if we were having a different conversation right now and it really all blown up, like what would that have looked like? Like some of those would have totally unpegged. Like, give me what in your mind would that have looked like?
I think the risk that some people must be aware of is that you can wipe out some of the protocols if they run out of collateral. So, I mean, like any collateralized lending protocol, you get liquidations that if they became under collateralized, then somebody's losing money, right? So the first pool is the protocol itself, if they have some kind of emergency fund. So I mean, like in an extreme scenario, you can imagine DAI, which is ETH backed by ETH loans on Maker. They could run out of collateral and then DAI depegs. So depending on how quickly it dropped, some percentage of DAI would basically not be redeemable for $1, and then a lot of stuff I think would unwind.
Right, because then people would just be running for the exits of like, give me any price to get out of the next one in the chain. Yeah. Yeah,
and then the other interesting thing, I think part of the reason why you get such vicious swings in crypto, especially to the downside, is you have real-time margining in a way that you don't really have, like real-time margining and settlement in a way that you don't have in traditional markets, for better or worse. So with something like that, I mean, I know Maker is interesting because they actually delay it an hour. Like their liquidation price for the CDPs is published an hour in advance. So it's like not at the block rate. It's like a little bit delayed, but it's still like pretty close to real time. And so if you're running up against margin calls, you're getting liquidated in real time, which obviously exacerbates the selling. So you could imagine like, really extreme unwind that just builds on itself, and you could end up with like no bid and some of this stuff. Even like Ethereum.
There was a good tweet thread of like, this is what a free market looks like, right? Of like instant liquidation and people running for the exits and nobody like stepping in to provide that liquidity necessarily. Yeah. Which wasn't all that bad.
Yeah.
Ben, back over to you. So, and maybe actually I'm going to go back to you, Gary, for just a second and give us some of these definitions of what you've been throwing around. So AMM is...
Right. So kind of like the first generation of centralized exchanges were central limit order books. I'm sorry, decentralized exchanges were central limit order books on chain. So you would like submit an Ethereum transaction to like place a bid, place an offer, and like they could match. And those are not a good fit for blockchain because it's expensive and slow. AMMs are kind of a new way to do the decentralized exchanges where you create a swap market for between two assets basically. So the market maker creates a pool with like two assets like A and B. It's whatever ratio they deposit into that pool between A and B it defines the initial price, and then liquidity takers can come in and provide A in exchange for B or provide B in exchange for A at some like fixed like swap rate effectively.
So there's basically just a pool there that you can access versus having to go out into the universe and find someone on the other side of the trade.
Yeah, exactly.
Ben, back to you. So you guys were some of the earliest users of the futures there. Why do you think other people, or have they been hesitant to move into that space and to say, hey, this is a good hedge? And what are you seeing as the premiums there to the spot? And then explain, if you can, just how the futures work, if some of the people don't know exactly how they work. Not futures in general, but how the Bitcoin futures work.
Yeah, I mean, I think the biggest distinguishing factor of the Bitcoin futures, especially relative to some of the other futures out there, are just the fact that they're cash settled, and then, like I mentioned before, the margin requirement, which is there for all different kinds of futures, but for Bitcoin, because of the volatility and because of the unknownness of the asset, both the exchanges and the futures commission merchants started off with really high requirements. And I think, to the point I was making earlier, that's definitely discouraged a lot of the market makers who tend to be global in nature from providing as much liquidity as they do in some of the foreign markets, foreign-based markets that have much lower margin requirements. I think that being said, the CME Bitcoin futures themselves, the big contracts, I think you've seen the statistics. The market has been growing, and liquidity has been growing, and I think for the futures themselves, it's pretty good, and it's definitely still handy for us when we invest, because there still is a benefit to not having to put up 100% to buy something. So even if the margin rate's at 35%, that still gives us a lot of flexibility in how we control our excess cash and our collateral. So there's still big benefits there, I think, for us. Like I said before, it's just if we could get a little bit more quoting and some more participants, which I think will eventually happen. And the options, that would be big. And we are interested to see what the micros do. I think the whole notion of bringing, making it much more accessible to retail, because a big contract, right? If they're 5 Bitcoin, and back when it was 50,000 a day or two ago, or whenever that was, you're talking about a $250,000 notional contract, and if you have to put up 35% of that, that's a big amount for quite, especially for individuals, obviously. So, this notion of 1/10.
Right. I could go on Robinhood or wherever and buy, or Coinbase and buy, right, 5/100th of Bitcoin or something.
Yeah, right. And so now that you've got the micros, that product should compete much more directly, to an extent, in theory, with the BitMEXs of the world, or some of the other perpetual contracts on some of these other exchanges that people have been using for a long time across the space.
Do you know off the top of your head that the futures trade at a premium, right, to the index price, to the spot price?
Typically, yes, and there has been a trade there that a number of our colleagues, I think, have been trying to access in one way or another. There's actually there's a front end out there called Paradigm that does a really good job to be able to capture that in terms of entering it basically as a spread trade. So whether it's people buying the front month contract and then selling the second or third month out and collecting that spread, typically it's in a contango curve. So the forward, the front month is cheaper than the back months typically. And there is quite a bit of premium. Some people do it by actually just owning the spot and then selling the future against it and waiting for those to converge into expiration. So there definitely is a trade there. And whether it's on the CME, some of the perpetual markets have better or worse, depending on the time frame, trades of the same essentially phenomenon where they can do the same thing. And I think actually Arthur Hayes wrote about that from BitMEX. He had a pretty good post on that a month or two ago, on just this trade that essentially, depending on when you put it on, you could get anywhere from 20 to 60% annualized type of returns by just, essentially buying the spot or near month and selling some of the out months. There's risk to those trades because it doesn't always converge the way you think. If you get in late, it's like any spread trade that you put on in a commodity, for example. I mean, there's risk to it. It's not a free lunch, but there is that opportunity there. There's firms actually that are trying to package that into structured products, which depending on how you manage your money, whether it's for you or if you're managing money for other people, can be potentially attractive even to pay sort of the vig that those providers would put on their product.
Right. Is that like some of these big firms we're seeing, like Morgan Stanley and Goldman, like coming out with, or was it Wells I saw today, coming out with a Bitcoin product?
They might be. I know. Oh gosh, I can't remember which one. It was one of the bulges that was doing like a non-deliverable forward, which actually was out there when we started investing in 2017. There was a group called Terra Exchange that was doing a non-deliverable forward. I think it'll obviously be much more successful with the bulge bracket, but this is actually a product I know from a group up in Toronto called FRNT that put together like an Ontario Securities Commission approved structured product to trade that. So I don't know the ins and outs of it, but essentially they price it like a zero coupon bond.
Right. And then in theory, Gary, I'm going to throw it back over to you. In theory, this type of volatility is sort of good for like this kind of farming and yield chase, all this kind of stuff, or no? Right? Like in theory, you can get bigger premiums on some of these option plays and whatnot if the volatility is higher, or do we need some sort of base level of value in order for that to happen?
Yeah, I think it depends on what kind of trade you're putting on. I mean, obviously, if you're trading back and forth, vol is good because there's going to be more dislocations. If you're like providing liquidity in an AM, it's kind of depends if you're hedged or not. So if you're just from the liquidity provision standpoint, more volume is good because or more volatility creates more volume. More volume is good because you collect more fees. The catch is you're going to have delta exposure if you're, for example, providing liquidity in an AMM because you're long both of those assets in the pool. But you can hedge those.
Do you think there's a bit of like the GameStop gamma delta hedging phenomenon that's gone on that drove prices so high and that cascaded down in this scenario as well? So that as there's more and more people making those markets and trying to make kind of non-directional bets and just earn yield, that they need to delta hedge and that'll drive the price further?
Yeah, it's a good question. I don't think that there's many people short vol. Like I don't think there are any like structural like levered people, like levered vol sellers. It's just like a good way to get your your head blown off.
Like you'd have to be some sort of crazy to be short this vol, right?
Yeah. So and interestingly, like from all the data I've seen on just the leverage in general, especially like even the centralized exchanges, like the margin contracts and the perpetuals, like the leverage was actually decreasing into this, which was interesting. Like over the past month or so, I think. So, yeah, like I don't.
Sorry, go ahead. I was just gonna say, what are both your thoughts on like the amount of leverage we're talking about in the whole system? I don't even know how a good way to quote that would be, but is it 5x, 10x, 50x? Any thoughts there?
I haven't seen a good like overall measure. I was kind of interested in it. I didn't look too hard. But it should be measurable. I mean, you have the open interest on all the perpetuals. You have the amount of outstanding like margin contracts. You have the on-chain like borrowing. So I think you could probably come up with a number. I don't have a sense that there's like a lot of the large holders are leveraged. I think there's a lot of small holders, playing around with like 20x, 50x, whatever, and they get stopped out pretty quickly.
Well, it seems just from my perusing FinTwit that it's like that's the big scare, right? Of like this is leverage upon leverage upon leverage, and as soon as it unwinds, it's going to kind of blow up the whole ecosystem. But it sounds like you're saying, not so much. Yeah. Like the big players are just they're holders for the main part, and they're going to be there.
Yeah, or they're just not that levered. I mean, with assets that are this volatile, like you can see even like a minor day would wipe out most highly levered players. So I think it's just like short terms, smaller, can be larger specs, but relative to like the amount of size coming into the market for longer term positions, I don't think it's that significant. I think you tend to see leverage, like tremendous amounts of leverage build up in markets that are kind of the opposite, that are like calm, perceived as more stable, like safer bets.
And so speaking of unstable, like what was the carnage on all the quote unquote shit coins today? I loved you on Pirates of Finance of like, well, then you create your fake thing, and then the so all these fake things, for lack of a better term, like what was the carnage there? Were they blown out, or was it in line with everything else?
I'm sure some probably had some particularly nasty days, but just like glancing at like the top 100, I mean, most things are down more than Bitcoin. Like Bitcoin was quite strong relative to almost every other asset. But like, I mean, I think they all kind of took similar types of hits, like 20 to 40%.
And then Ben, for you, of like part of your success for your fund and for moving forward would be kind of mass adoption, right, of by institutional and kind of pushing prices higher. Is that fair to say? Do you think this set that back? Do you think like these pensions and endowments that were like, okay, maybe we should put 2 to 5% in Bitcoin, are like, well, hold on, this thing lost 50% in 3 months. Should we reassess those plans?
Yeah, that's a good question. I mean, that's the question that we kind of love to answer, I guess, for our fund. I think just in general, our investing philosophy is always a little bit more on the conservative side, even in this space. And so we always take the view that we're looking to try to protect the downside as much as we can. And there's numerous different ways we do that. So I think, it's a good question for these bigger investors to be asking. And I think that's what makes this so interesting to us, this space, is because there's just an ironclad, in our opinion, case for active management. I think if you look at the traditional markets, which I grew up in, on the mutual fund side, it's pretty difficult for active management to really provide a ton of additional alpha in most cases, in the traditional world. So I think here there's so much movement, and I think if you understand risk and understand how to manage that, there's huge opportunities. I think one thing that we always look at, no matter what market, but particularly for this market, is we try to look at breaking beta down between upside and downside beta, which sounds pretty simple, and it's not overly difficult. But I think just going through the exercise and realizing that, like Gary was talking about just earlier, today some of the things that we watch, not necessarily that we own, but some of the things that we watch were down 60% versus USD, at different times during the day, with Bitcoin down maybe 20% on the day or 25%. And I think, you just have to constantly look at those risk reward ratios and say, hey, the downside vol is 2.5x, but when these things are really running like the past 6-7 months, some of these coins can make 10x while Bitcoin goes up 1x. And so
Wait, so you're saying you look at like a portfolio of coins, not Bitcoin, and assign a beta related to Bitcoin? So basically, like,
yeah, exactly.
Okay, so like ETH has maybe that's a bad example. It might be around the same, but maybe it's 1.2 beta to Bitcoin, and Algorand is like 3.5 or something.
Exactly. And then it just depends on, there's differences like on the downside versus the upside, right? Like when things are really cooking, Ethereum can outperform. So I guess to try to, that was sort of a roundabout way of answering your question, but I think, what we've really noticed is, and I'm sure Gary would say the same thing, like, these new entrants come in every year and a half, or every 6 months, and everybody goes through the same learning curve, right? So whether it's an institution, or an individual. They learn about Bitcoin, they have the aha moment, they get really into it, they go out and they buy Bitcoin, and then they start learning about Ethereum. They look at the coinmarketcap.com and say, what's this other thing that's got the huge market cap? And they start learning about Ethereum, and then they become, just really amazed at what Ethereum can do. And so you see these patterns come in, and I think, what we saw over the last month or so is this huge dispersion, obviously this month too, between people finally catching on. I think a lot of the new entrants catching on to what's different about Ethereum versus Bitcoin, and sort of all the possibilities that there are out there. And you saw this huge dispersion in performance. At one point this month, I think Ethereum was up, I don't know, like 50% or something like that, and Bitcoin was down 10 or something, if I have that right. So, that actually reminded us a lot of the end of 2017 and beginning of 2018. There was a similar divergence there. But I guess, this is a long-term thing. I think the institutions that have already come in are, they dipped a toe. And so I don't think institutions like that are necessarily going to freak out over, a month like this. I think they'll learn a lot more about what makes the market tick, and get comfortable with it. But I think the bottom line is that what they should understand is, with great reward potential comes substantial risk, and so you have to size positions accordingly.
I think in my brain, I feel like as an allocator, I would go to cool, I don't care whether it goes up or down. I want to access the volatility, or I want to access the yield that this volatility provides, or the yield that these different dispersions provide. So it's right, it seems to me like if you're buying if you're going into a personal lending, the name is escaping me, you know what I'm talking about, one of those platforms where you're accessing all that, right? You don't care that the one guy's doing a car wash and the other guy's doing a llama farm or something. You're just doing micro lending and getting the yield back. So to me, as you get all these more and more and more coins, maybe that's what it morphs into. I don't know. Any thoughts on that? I rambled for a bit there, but.
No, I think embracing the volatility is one of your points, and I think that's a good thing to do. There's opportunity in the volatility, and you're seeing it today. If you can be protected to an extent and not have all your chips on that table, and we don't know if this is the bottom or not, and it very well might not be. But just to have the flexibility and to take advantage of that, whether you're a long-term investor or you're providing liquidity, like Gary said, in a pool, and maybe you've been able to hedge some of that delta or impermanent loss that's there, and you're clipping fees. There's a lot of opportunity in the space because of the volatility and because of some of the uniqueness of these liquidity providing opportunities that are essentially a different, or a newer form, I guess, of yield, really.
Gary, anything to add on to that?
Yeah, I think that's the part that especially people from traditional finance backgrounds tend to latch onto, because it's so relatable. I would say that I still think getting at the asymmetric beta point that Ben brought up, I still think majority of the opportunity still ends up being being that long, at least being that long the right assets, obviously, which is partially why I think you see some of these other opportunities like the futures carry and stuff like that. It's just the money in the space when it sees, okay, I can make 30%, 40% annualized putting on this basis, or I could spread that risk capital across 10 projects and a few of them might 100x. They're taking that asymmetric upside, and so far it's paid off. It's been way more attractive. So
so you're arguing against doing some of the yield stuff and saying if I spread it out against 10 bets, maybe one of them is a more of a venture capital model?
Yeah, I find that more attractive myself, but it's part of a portfolio, right? It depends on obviously those aren't going to be perfectly correlated. Depends on your risk appetite. In general, I see most crypto exposure as a call option for me.
Yeah.
So,
but
I think
YOLO call option, like, or just like, hey, I can do this for a relatively small amount of my net worth, and the potential rewards are huge.
Yeah, I mean, it started as a smaller amount of my net worth, and that's substantial.
Well, Ben had hair 2 weeks ago, so it's been a tough 2 weeks.
Right. Oh, it's all gone. No, he makes a good point though, and we talk about this too. Like, for us, it's probably more of a collateral issue, but we have the same discussions here about, hey, great, you can, we can park, we can park some stable coin. Like if we want to be, really traditional, we could park it at like a BlockFi, for example, and we could make a nice, 8%. But if the choice is between that and putting it into a new project that we've researched, a new coin that we've researched that could potentially return so many multiples of that, and as long as we're comfortable with the risk side of the equation, it does make it difficult for us, because we do have a view similar to Gary in the sense that we're longer term looking. We'd like to take advantage, if we can, of these periods of stress and volatility. And I think, we're able to do that from time to time. But yeah, it's, there's a lot of opportunity. And I think the DeFi space is going to continue to grow. But there is a lot of risk, even in the 8% yield. I mean, if you understand, and I'm sure Gary knows this much better than I do, we're just starting to get into it. But if you understand part of how they're able to offer those rates, part of what they're doing.
It's like an unsecured loan, right? That should be maybe like 60% or something.
Yeah, I don't know what the right number is for it. I mean, maybe it's priced correctly, maybe it's not. It seems like maybe it's not quite, but I don't really know. What I do know is that part of it's not just a net interest margin business, right? Like there's some demand from funds like ours and from other players out there that are looking to borrow Bitcoin and looking to borrow some of these other assets, like market makers, to put on short positions or just to spread coins around to different exchanges. So they have inventory there to be able to make these markets efficiently from an operations standpoint. So there is demand, but there isn't enough demand out there to pay the rates that they're paying. And so part of how they're making that difference up, the way I understand it, is they're actually going in and taking part of the capital that you deposit there as a depositor, and they're actually going out to these DeFi protocols and trying to clip these 30, 40, 50% annualized rates by providing liquidity, or quote unquote yield farming, and getting some of the reward tokens back, and when times are good and the liquidity and the reward tokens are going up too. I mean, there's like these added kickers, and so it's
right. So it yield farming in a down 50% over 3 months, it won't really work, right? Because you're getting those reward tokens that lose money. So then you don't get a kicker you can add to the yield.
Yeah, I guess your kicker goes away, but Gary could probably talk more about it. I mean, you're making the fees. If you're able to hedge the delta, as he calls it, or the impermanent loss, maybe it is a good strategy in a down market if you really know what you're doing.
I think if you there's like, depends on what assets you're doing, for example, but I mean, staking is the simplest case, right? Like, let's say there's some protocol where you're getting a bunch of bonus tokens for staking. I mean, like, again, the simplest case is if you're staking stables, you don't really have any downside unless it depegs. It's just the opportunity cost of those stables. So now you're getting reward tokens.
And explain staking real quick. So I have $100,000. I put actual $100,000 into this. I stake one of the stable coins. Basically, I back that.
Yeah. So you're like depositing something. Stable would be one example, into a smart contract. So you're taking the smart contract risk. You still have risk if the stable goes, depegs.
Yeah.
But in exchange for doing that staking, that smart contract's rewarding you with some kind of like governance token or some kind of bonus token. And yeah, in a bear market, those things are losing value, but they're still worth something, right? So maybe like you thought you'd make 50%, now you're making 20% annualized, but still something.
And then coming back to both, you kind of have this VC model of like, okay, I want to pick the winners. But to my understanding, right, and this is widely simplistic, but like Ethereum is better than Bitcoin, right? And Aave is better than Ethereum. Like they keep improving, right? Improving the transaction speed. So you just view those as each is a little different and doing something different, or are they improving upon, you know what I'm getting at? Like in theory, you could launch when 1 million of these things are launched and they'll be improving, the technology gets better every time. Like, doesn't it devalue the previous batch?
Yeah, I think there's like been a constant debate about where and how value accrues in the long run. I feel like over the past few years, it's been a combination of like hype and narrative.
Yeah, I wanted to get to that next, right? If like, if the 10 winners, or you're trying to pick one huge winner out of the 10, and it's just because it got hyped by Portnoy or something, right? Is that legit, or do you care? And is that dangerous and bad for the space overall? Like if that's the only benefit is coming from things getting hyped?
Yeah, I think there's kind of two, and if you're really good, you can do it both ways. Like one is trying to pick the hype winners, and like that's a lot of these chains. Like if you're looking at like Cardano or something, like nobody's using Cardano, but it's just got a lot of hype. I think there's definitely an alpha in being able to predict what other people are gonna, get excited about and buy. It's a different skill set than the other one, which is like predicting which products people will use and accrue value because of that. So that would be like Uniswap I think is a good example. It generates lots of fees for the LPs using the actual product. So it's got real volume, it's got real usage. Currently those fees aren't accruing to the governance token holders, but they could like vote in, a dividend effectively. So I think if you were able to predict that, like, okay, AMMs are going to become really popular. Uniswap has one of the better products. It's got a lot of traction. Like you could have made that bet.
And that comes back to like early on promotion for Bitcoiners, right? Like this, imagine if you could have invested in the HTTP protocol, right? So you're kind of saying like some of these things are the actual protocols that transactions are getting made on, and you can earn a fee from that protocol being used.
Yeah, exactly.
Yeah, which is sort of weird to me. It seems like that's not the whole holder FinTwit presence, right? Of like, we're changing the world and fiat's dead and crazy, right? It seems like totally the opposite. Of like, no, we're just as bad as the investment bankers and creating something we're going to make a vig on each trade.
Sure.
Does anyone have a problem with that? No.
I don't have a problem with that. I don't think you can like eliminate like business organizations. I mean, they might look different, but.
And then I got to bring up Elon. Any thoughts there? Is he good for the space, bad for the space? You think he's playing this totally? Just, you think they have a big map in their boardroom of like, okay, we're going to promote it here, we're going to sell it there, we're going to buy it back here? Any thoughts, Ben?
I mean, it's pretty hard to figure it out. I think we definitely know that there's influencers like him that do matter in the short term. I think the way we sort of try to come to a conclusion about a guy like that in scenarios like this is just that, we're taking a longer term view. If something that he does in the short term creates an opportunity for us, good or bad, we'll definitely evaluate that like we would any other opportunity. Typically with a healthy dose of technical analysis. Obviously we saw the market topping, or I should say we saw signs that the market could be topping in the short term before Elon sort of went haywire with some of his, twisted the knife. I think one of the things that we were looking at was actually some of the mining stocks, some of the equities that started to act pretty poorly, I'd say. While Bitcoin and the rest of the space were still doing quite well. That kind of gave us a warning. There were some other things on the momentum side that we look at that also piqued our interest. And then obviously just looking at the run up over the past 6 to 7 months, nothing ever really goes in a straight line. I mean, even lumber's come off a little bit, right? So it's,
Yeah, you touch on something interesting there. Like, do either of you view Bitcoin as like a new, not so new anymore, but just a new risk metric, right? Of like, when it's going up, risk is on. People are willing to put on risk, not just in crypto, but across the spectrum. And like this sell-off is a symbol that risk is coming off, and people across their portfolios are delevering. All right, and then there's also the interesting twist that basically the Bitcoin sell-off drove losses in the Nasdaq and drove like actual real economy stock prices moving lower. So any thoughts on, will that keep getting more correlated of crypto prices with stock prices, or do you think that's just because Cathie Wood's coming in, all this stuff is happening with people trying to invest in crypto without actually buying the crypto?
I'm not sure. There's
part question. Sorry.
Yeah, I mean, I guess the cop out answer is I'm not sure if there's enough data yet to really be able to tell what the correlations are. I mean, I think
we've got this one data point now, basically. Right?
Yeah, I mean, look, if you look back to March of last year, 2020, a lot of Bitcoiners and others in the space were very disappointed that I think what they were really wanting was a 1-for-1 negative correlation between Bitcoin and the traditional markets. So when there was all the turmoil over the lockdowns, et cetera, in March, that were really, taking quite a hit out on the equity markets. Bitcoin basically, followed suit, or you could say it vice versa, but whatever, it was pretty simultaneous, where they both went down for, at least Bitcoin, for really only a day or two, actually, before it bottomed. So, I think the whole notion of the lack of correlation, I think we're getting to the point where there's, enough data to see that, at least from the beginning of Bitcoin until now. And I think that's the important thing. I think people confuse a lot of times non-correlation with negative. I mean, sometimes in the short term there's going to be correlation, and I don't think that should be that surprising. But I think you do have a point there that, look, I mean, there's some definite weakness in tech on the equity side, and the things that we look at on the momentum structure side are definitely signaling there's some problems there now. Whether the printer gets turned back on and the Fed steps in, those are all variables to take into account. I mean, wish we had a crystal ball. I think Bitcoin definitely, I've seen it. We've seen different periods where it's led the other markets. So could this be one of those times? It could be.
Yeah. What is that?
Yeah.
Yeah, I think short to medium term, like logically to me, it seems like it becomes more and more of a risk asset. So like, I think we've seen the correlation kind of go up over time, from like none to maybe now there's like some, and like I would expect that to continue for a while. I think I could make an argument for why there's some point in the future Bitcoin could be negatively correlated to like risk on, and it maybe it becomes like a stable store of something, but I think we're pretty far from that.
Right, more like gold, right? That's the dream. And then two more things before I let you go. I got to take my son to his baseball game, but like in oil markets, right? Like oil at $40, or no, let's say oil at $40, like the Canadian flats are no longer profitable, or deep sea drilling in Gulf of Mexico is no longer profitable, right? And oil at Saudi Arabia can still get it out of the ground for 20. So like cost of production. So do you feel like there's any similar thing in Bitcoin price? Like if it gets down to 15,000, all of these projects are no longer profitable or something like that. Is that a stretch?
Yeah, I think that there are prices where miners will shut off. They're pretty low compared, like, I mean, it's in the single digit thousands of dollars for Bitcoin. So I think right now you're not going to see much. Like you might see a little bit less investment in new hash rate, but also remember like the difficulty adjusts. So I think in general, like we're in a secular upswing in investment in crypto, and that means mining as well.
Yeah, I'm thinking of it more of like just for like venture money coming into the space. Of like, I see what you're saying, but also of like at above 50,000, there's people are taking meetings. Below 20,000, like you're not getting the meetings anymore.
Yeah, I think that's like a whole other can of worms where right now, like most of the venture money is like recycled in the space. So it's a lot of these active trading and market making firms that are making money hand over fist, and they just like recycle it back in. So for them, it's like not so much the price level, it's just volume.
You got some names of those kind of firms?
Yeah, like CMT, Three Arrows, Alameda. I mean, they're kind of the go-to for anyone in the space because they know it. They're gonna give you money on like a handshake and like not even a Zoom meeting. Sometimes there's no real due diligence, and like they're hyper bullish on everything basically. So it's like the perfect capital partner if you just want to get some VC and go.
Yeah. And then my last thing is my pet peeve of all these tweets that such and such athlete's going to get 100% of his salary in Bitcoin. Can you guys both dispel all that for the listeners, right? The Atlanta Falcons don't have a pot of Bitcoin that they're paying, right? Wallet to wallet paying the athlete. Aren't they really just saying like this athlete is going to take whatever he gets paid and convert it immediately into Bitcoin? Anyone have an issue with that?
Yeah.
That's just my personal cross to bear, I guess. Right? Like it just makes no sense. Like, no, they're not paying him in Bitcoin.
Well, I've seen the answer is I don't know either, but I mean, some of the franchises and who knows have tried to say that they'll accept Bitcoin for, I don't know, I guess season tickets or, luxury boxes or something. So I guess in theory, I don't think the math would add up, but they could theoretically pay that to some of the players. And yeah, but the question is the same either way. Like if the players get paid in Bitcoin somehow, are they immediately converting or what do they do? Like, obviously, they're their own business. So to some extent they've got to pay bills and et cetera. So they're going to convert some of it at some point. Yeah, I guess it's
headline making. Like 15 years ago, it would have been like, such and such decides to get paid 100% of his salary in government bonds, right? Like, no, he's just buying, he's putting it in a savings account. Anyway, guys, any last thoughts before we jump? It's all good. Well, thanks so much for coming on. Hopefully we stabilize for both of you and your personal investments and your businesses, but it's been fun to watch from afar, and we'll have you guys back on again sometime.
All right.
Nice job.
Thanks,
right. Thanks, guys. Take care.
That's great. Bye.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.